Did you know that 76% of millionaires don't have a college degree? That's right. Many wealthy individuals didn't climb the corporate ladder through traditional means. Instead, they mastered the art of using debt to build their fortunes. While most people fear debt, the wealthy see it as a tool for growth. Here's a shocking fact. According to a 2021 study by the Federal Reserve, the average American household carries over $7,000 in credit card debt. In contrast, the wealthy use debt strategically, leveraging it to invest in assets that generate income. They borrow money not just to spend, but to grow their wealth. So, what's the secret? In this video, we'll explore how the wealthy distinguish between good debt and bad debt, leveraging strategies like OPM, other people's money, and debt recycling to fuel their financial growth. You'll discover how business credit can turbocharge profits and how real estate investments serve as powerful cash flow machines. By the end, you'll understand why debt isn't the enemy. It can be your greatest ally in building wealth. So, stick around as we uncover the surprising truth about how the rich use debt to create their financial empires. You won't want to miss these strategies. Chapter 1. The secret weapon. Good debt versus bad debt. Debt is often seen as something to avoid, but the wealthy use it as a tool to grow their wealth. The key difference is understanding good debt versus bad debt. Good debt is used to acquire assets that appreciate over time or generate income. For instance, taking a loan to buy real estate can bring in rental income while the property's value rises. On the other hand, bad debt drains your finances, like high-interest credit cards or personal loans used for depreciating assets. According to a 2019 report from the Federal Reserve, 40% of U.S. adults have credit card debt. Many of them are stuck paying high interest on things that don't make money. But the wealthy think differently. They take on debt with the goal of earning more than they owe. Robert Kiyosaki, author of Rich Dad Poor Dad, puts it simply: good debt makes you richer. Bad debt makes you poorer. The wealthy also understand interest rates. When borrowing, they look for low-interest loans tied to investments that earn higher returns. They might take a 3% loan to invest in something that yields 8%. Over time, the difference adds up to significant gains. For example, a $100,000 loan at 3% over 30 years will cost roughly $155,000, but if that loan is invested at 8%, it grows to $1 million. This ability to borrow low and invest high is the secret sauce. The wealthy master the art of using debt as leverage. They make it work for them, turning borrowed money into more money. And that's why debt, when used correctly, is a weapon for building wealth. Chapter 2. Leverage the power of OPM, other people's money. OPM, or other people's money, is a powerful concept that the wealthy use to scale their investments without risking their own capital. It's about borrowing money to make more money, plain and simple. In fact, according to Forbes, 90% of millionaires attribute real estate investments, fueled by OPM, as one of the key ways they built their wealth. One of the best examples of OPM in action is real estate. Let's say you buy a rental property using a mortgage. You're using the bank's money, but the rental income helps pay off the loan. Over time, the property appreciates, and you've used other people's money to build wealth. It's not just about borrowing from banks, either. Wealthy individuals also use investors, partnerships, and even government programs to raise capital. For instance, some might get private investors to fund a business venture or property deal. In this scenario, their personal financial risk is reduced, but their potential reward is huge. A classic quote from Think and Grow Rich by Napoleon Hill states, "Riches begin with a state of mind, with definiteness of purpose, with little or no hard work." The key is mindset. The wealthy think in terms of leverage. They look at how they can control more assets using less of their own money. Another way they use OPM is by refinancing their investments. Let's say you buy a property, fix it up, and its value increases. You can refinance it at the higher value, pull out equity, and reinvest that money into another property. This is a cycle where OPM helps you build a portfolio with minimal personal investment. The big takeaway? The wealthy focus on control, not ownership. By using OPM, they control more assets, increase their cash flow, and multiply their wealth, all while minimizing personal risk. Chapter 3. Real estate, the debt-fueled cash flow machine. Real estate has long been a favorite of the wealthy because it's a cash flow machine fueled by debt. In fact, a 2020 survey by Statista found that 41% of millionaires made their money through real estate investments. The trick is using debt to your advantage, especially when it comes to rental properties. Let's break it down. You take out a mortgage to buy a rental property. The tenant's rent covers your mortgage payments, and in some cases, it even generates extra cash flow each month. So, you're using the bank's money to buy an asset that pays you every month. Meanwhile, the property's value is likely going up over time. This strategy creates both income and wealth growth. This is why real estate investors often talk about good debt. With real estate, good debt means you're borrowing to buy income-producing assets. Plus, real estate comes with tax benefits. You can deduct mortgage interest, property taxes, and maintenance costs. According to the IRS, real estate investors can write off depreciation, even if their property is increasing in value. This reduces taxable income, which is another way the wealthy build their fortunes through real estate. The wealthy don't just stop at one property. They often use a strategy called the BRRRR method: buy, rehab, rent, refinance, repeat. Here's how it works. You buy a distressed property, fix it up, rent it out, and then refinance it at a higher value. The cash from refinancing allows you to buy another property and repeat the process. With each new property, your rental income grows, and so does your equity. Another factor to consider is appreciation. Real estate values tend to rise over time. From 1968 to 2021, home prices in the U.S. grew at an average annual rate of 4.6%, according to the Federal Housing Finance Agency. So not only do you benefit from rental income, but your property's value increases, too. The key is patience. Wealthy investors hold onto properties long-term, letting the debt pay itself off while their equity grows. In short, real estate is a reliable wealth-building strategy because it combines cash flow, appreciation, and tax benefits. And all of it is made possible through the strategic use of debt. The wealthy understand this, and they use real estate as one of their primary tools for growing their fortunes. If you're finding this content valuable, make sure to subscribe for more insights on building wealth through smart financial strategies. Chapter 4. Business Credit. Turbocharging profits without personal risk. Most people don't realize how powerful business credit can be. It's like a secret weapon for entrepreneurs and investors who know how to use it. Unlike personal credit, business credit allows you to borrow money for your company without tying up your own assets or putting your personal finances at risk. One of the key advantages is that business credit doesn't affect your personal credit score. So, while you're building your business, you're keeping your own financial situation separate and safe. Many successful business owners leverage this to scale faster. A 2019 U.S. bank study found that 82% of small business failures are due to cash flow issues, and having access to business credit helps avoid this. Building business credit can also help you access larger amounts of capital. Once your business establishes a good credit history, you can secure larger loans or lines of credit at better interest rates. For example, a business with strong credit can secure a $100,000 loan at a lower rate than someone using personal credit, which means lower costs over time. What's interesting is that you don't need to have a large corporation to benefit from business credit. Even small businesses can start building credit by getting a business credit card, paying bills on time, and applying for small loans. Over time, this builds a credit profile that banks and lenders trust. One book that highlights the power of business credit is The Millionaire Fast Lane by M.J. DeMarco. He explains how entrepreneurs can use other people's money, like banks and investors, to scale quickly without risking their personal finances. It's about building wealth fast while protecting your personal assets. Using business credit also comes with tax benefits. For example, the interest on business loans is often tax deductible. This means you're borrowing money to grow, and you can deduct those interest payments from your taxable income. It's a double win for building wealth. Business credit isn't just for expanding your company. Many entrepreneurs use it to invest in other opportunities, like real estate or stocks, keeping their personal credit clear. This flexibility allows for greater diversification without the same level of personal financial risk. In short, Business credit is a tool the wealthy use to supercharge their profits while keeping personal risks to a minimum. It's about leveraging what you've built in your business to open new doors and build wealth faster. Chapter 5. Debt recycling. Turning liabilities into cash-flowing assets. Debt recycling is a lesser-known but powerful strategy the wealthy use to turn liabilities into assets. It's all about using the same money over and over to generate new streams of income. Sounds complicated, but it's actually a smart way to keep building wealth. Here's how it works. You take on debt to buy an asset, like a rental property or an investment in the stock market. Over time, that asset produces income or appreciates in value. Then, you take the profits from that asset, refinance or sell it, and use the cash to pay off the original debt and reinvest in new assets. You're essentially using debt in cycles, with each cycle growing your wealth. One classic example is in real estate. You buy a rental property with a mortgage. The rental income helps pay off the loan, but as the property's value goes up, you refinance it to pull out equity. You can then use that equity to buy another property, continuing the cycle. Each new property brings in more rental income, which further pays off debt and funds future investments. Another way to look at it is with stocks or dividends. Some wealthy investors take out loans to buy stocks or other investments that provide dividends. The dividends can be used to pay off the loan, while the stock's value increases over time. You're using borrowed money to create cash flow while building equity. One interesting fact is that debt recycling can be tax efficient. In countries like Australia, for example, interest on loans used for investments is tax deductible. So, not only are you using debt to buy assets, but you're also reducing your tax bill in the process. According to Unshakable by Tony Robbins, wealthy people understand how to compound their money and keep reinvesting it. They let their money work for them, not the other way around. Debt recycling is a perfect example of this. It's about turning borrowed money into a money-making machine. The key to making debt recycling work is discipline. You have to stay focused on reinvesting the profits and managing the debt wisely. For the wealthy, it's not about paying off debt and being debt-free. It's about using debt strategically to keep growing their assets. The beauty of debt recycling is that it allows you to build wealth faster. Instead of waiting years to save up and buy another asset, you're using the equity from one to fund the next. The wealthy understand this cycle and use it to grow their fortunes exponentially. If you enjoyed this video and found the insights helpful, don't forget to subscribe for more valuable content on building wealth and mastering your finances.